Rick Rule sold not 10%, not 20%, but 80% of his physical silver. At nearly $100 an ounce, while the world is screaming, silver is just getting started. Silver is never coming down again. New era, new system, new money. Rick Rule quietly did the opposite. He exited most of his silver and moved that money somewhere else. Not because he's bearish, not because he's scared, but because, in his words, the real opportunity just shifted. What he saw, what most silver investors completely missed, is something that could decide who multiplies their wealth in 2026 and who gets emotionally trapped at the top. And by the end of this video, you'll understand exactly why he did it and what move he made next. Because what Rick Rule just revealed could change how you look at silver forever. Welcome to Market Metal, the home of real market stories, real asset truth, and the kind of thinking that only comes from years of watching cycles rise and fall. If you're someone who's lived long enough to know that markets don't move in straight lines, if you understand that protecting wealth is just as important as growing it, then you're already one of us. So take a second, treat this channel like a place you come back to, and subscribe. Not for noise, not for hype, but for perspective. And before we begin, I'd love to know, where in the world are you watching from today? Tell me in the comments. Now, let's talk about why Rick Rule sold 80% of his silver and what he bought instead. The signal most investors misread. In January 2026, when silver was trading near historic highs, a quiet decision sent a powerful signal through the commodity world. Rick Rule, a veteran resource investor known for decades of disciplined capital allocation, disclosed that he had sold roughly 80% of his physical silver holdings. The announcement did not come with panic. It did not come with fear. It came with clarity. For many investors, the reaction was immediate and emotional. Silver had spent years moving from neglect to obsession. The narrative had become familiar. Shortages, industrial demand, monetary debasement, geopolitical stress. Online discussion spaces were filled with declarations that silver had entered a new era. The belief was widespread that prices could only move higher. In that environment, selling silver appeared irrational to many. But Rick Rule was not acting as a commentator. He was acting as a capital allocator. Those who have studied long cycle investors understand that they do not treat markets as stories. They treat them as systems. They do not ask whether an asset is good. They ask whether it is still the most efficient place for capital under present conditions. And often, the most important signals in markets do not come from what experienced investors say. They come from what they quietly do. Rick Rule had not turned bearish on silver. On the contrary, he continued to express confidence that precious metals would benefit over the long term from declining purchasing power in major currencies. He did not claim that silver had reached a final top. He did not announce the end of a bull market. Instead, he did something far more revealing. He reclassified silver. For years, silver had occupied the speculation portion of his capital structure. It was not insurance. It was not a savings vehicle. It was a position built on a specific condition, that silver was deeply disliked, mispriced, and ignored. The opportunity existed not because silver was understood, but because it was dismissed. That condition no longer existed. By early 2026, silver was no longer a hated asset. It was a celebrated one. The metal had moved from the margins of portfolios into mainstream conversation. Commentators debated price targets rather than survival. New participants arrived not because silver was misunderstood, but because it was now widely believed in. To long cycle investors, that shift matters more than any headline. Markets do not reward belief, they reward asymmetry. Asymmetry exists when risk is widely perceived, but opportunity is not. It disappears when opportunity becomes the story. When ownership grows, when narratives harden, and when consensus forms, the nature of the opportunity changes. Future returns begin to depend not on recognition, but on continuation. And continuation is a far more fragile foundation for capital. Rick Rule, DDS decision to reduce his physical silver exposure, did not express doubt about silver US role in the global system. It expressed discipline about where marginal capital would now work hardest. In his framework, physical silver had moved out of the speculation category and into something closer to insurance. It still had a role, but not the same role. Insurance is held to protect. Speculation is held to multiply. The distinction is critical. Physical metals tend to perform best when disbelief turns into acceptance. Once acceptance is widespread, metals can still rise, but the character of the trade changes. Gains become slower, volatility increases, and corrections become psychologically violent. The asset no longer needs discovery. It needs constant reinforcement. That is not an environment where speculative capital is best deployed. The sale of 80% was not a retreat. It was a redeployment. A decision to move from an asset whose value depended primarily on price into assets whose future value depended on business performance, margins, and structural re-rating. A decision to move from an asset whose value depended primarily on price into assets whose future value depended on business performance, margins, and structural re-rating. This is the behavior that separates professional capital from narrative capital. Professional capital does not fall in love with vehicles. It follows function. When Rick Rule first accumulated silver, he did so because silver functioned as an unloved trade. It offered exposure to monetary disorder, industrial demand, and financial stress, while being largely absent from institutional portfolios. The expected return came from perception changing. By 2026, that change had occurred. The silver price no longer needed to be discovered. It needed to be sustained. That is a different risk profile. History provides many examples of what happens when markets cross this psychological line. Assets do not collapse simply because they are popular, but they become vulnerable to their own followers. Each pullback tests belief. Each consolidation invites panic. Each policy shift creates instability. Late cycle assets often move higher in price while becoming poorer vehicles for speculation. The public focuses on direction. Capital allocators focus on structure. Rick Rule's action belongs to the second category. He understood that capital grows fastest when it moves from where optimism has concentrated into where valuation has not yet adjusted. He understood that the strongest future gains often come not from the asset that headlines celebrate, but from the secondary layers of the same theme that have not yet been fully priced. This is why his decision was not framed around selling silver. It was framed around what came next. The sale of physical silver was only the visible part of the signal. The real message was the rotation that followed. A shift from a store of metal to the businesses that extract it, from a passive asset to operating systems, from price exposure to margin exposure. For entrepreneurs, investors, and business builders, the lesson is not confined to commodities. Every industry experiences phases of neglect, discovery, expansion, saturation, and restructuring. The greatest fortunes are rarely built by staying in the first successful expression of a theme. They are built by recognizing when that expression has completed its work, and when capital must migrate to the next layer. Rick Rule's silver decision illustrates this moment. It marks the point where belief became widespread, and when belief becomes widespread, the opportunity begins to move. In the parts that follow, the focus will shift from what he sold to why the structure of physical silver had changed, and why the mining sector emerged as the next strategic field for capital deployment. When a powerful asset stops being the best weapon, when an asset captures the public imagination, it feels dangerous to question it. By early 2026, silver had reached that stage. What had once been discussed quietly in commodity circles was now debated openly across financial media. Silver was no longer something people researched. It was something they defended. Price targets replaced valuation. Conviction replaced analysis. And in that psychological shift, a subtle but critical change took place. Silver stopped being an opportunity built on misunderstanding and became a position built on agreement. For disciplined capital, that transition is never cosmetic. It is structural. Rick Rule's decision to sell most of his physical silver did not come from disbelief in the metal. It came from a reassessment of what physical silver had become. In his framework, assets are not permanent identities. They are temporary tools. Each tool is judged not by what it represents, but by what it can still realistically deliver. Physical silver, by 2026, had delivered its first major service. It had moved from rejection to recognition. That journey alone often produces extraordinary gains. It is where mispricing corrects. It is where ignored fundamentals finally enter price. It is where asymmetry works hardest. But once that journey completes, the nature of the instrument changes. Future returns no longer come from discovery. They come from continuation. And continuation is always more fragile than discovery. In discovery phases, capital benefits from structural disbelief. The market resists the asset. Supply is dismissed. Institutions are absent. Valuation models underestimate. The asset advances not because everyone agrees, but because reality slowly overwhelms skepticism. By contrast, in continuation phases, the market already agrees. Capital inflows have arrived. Positioning is crowded. Expectations are visible. Returns depend not on recognition, but on persistent reinforcement of the same story. That is a far less forgiving environment. Physical silver, by 2026, was no longer primarily a recognition trade. It had become a maintenance trade, one that required prices to continue rising to justify new ownership. One that exposed holders not only to upside, but to sharp psychological reversals when volatility returned. And volatility always returns. History offers consistent patterns here. Secular bull markets rarely move in straight lines. They surge, then fracture. They advance, then exhaust. They climb, then violently correct, often without changing their long-term direction. These internal shocks are not anomalies. They are mechanisms. They transfer ownership from emotional participants to structured capital. Physical metals are especially vulnerable during these phases. They offer no internal adjustment, no margin expansion, no operating leverage, no cash flow response. They only reflect price. When price stalls, physical holdings stagnate. When price falls, they transmit the full psychological force of the decline. For investors who entered because they believed, those phases feel like betrayal. For capital allocators, they are expected. Rick Rule did not wait for that environment to arrive. He recognized its approach. He understood that while silver could still rise over the long term, physical silver had ceased to be the optimal speculative vehicle. Its role was transitioning from multiplication to preservation. Preservation assets are not abandoned. They are resized. They move from the speculative side of the ledger to the insurance side. Insurance is not meant to perform. It is meant to remain. In Rule's own allocation logic, physical metals fit this second category once recognition had occurred. They protected purchasing power. They hedged systemic risk. They provided monetary optionality. But they no longer offered the same probability-adjusted upside that they once did. That difference drove the sale. Not total liquidation, not rejection, reduction. The majority of the position was removed not because silver's future was weak, but because its present structure had become crowded. Capital was being deployed where it was already comfortable. And comfortable capital rarely multiplies quickly. This is one of the most misunderstood aspects of professional investing. Strong assets are not always strong opportunities. An asset can be structurally important, macroeconomically justified, and historically supported, and still be the wrong place for incremental capital. What matters is not whether something will survive. What matters is where additional capital will produce the greatest marginal effect. By early 2026, additional capital entering physical silver faced several constraints. First, valuation compression. Much of the repricing that accompanies recognition had already occurred. While further upside was possible, the ratio between risk and expected return had narrowed. Second, volatility expansion. As participation broadened, the likelihood of large, destabilizing corrections increased. These corrections do not destroy long-term theses, but they frequently destroy positioning. Third, psychological saturation. The more passionately an asset is believed in, the more violently it is defended, and the more violently it is abandoned when stress arrives. In such environments, disciplined investors stop asking how high something can go. They start asking what breaks first. Rick Rule's action implied that physical silver's next phase would not be linear. It would likely involve sharp drawdowns, emotional exits, and long consolidations. None of those environments favor assets whose only engine is price. They favor structures. They favor businesses. They favor instruments that respond internally to conditions, rather than merely reflecting them. That recognition is what made physical silver less useful as a speculative weapon. Not weaker, not wrong, less efficient. For serious decision makers, this moment carries a broader lesson. Every major opportunity goes through the same arc. First, it is ignored, then it is ridiculed, then it is debated, then it is accepted. Finally, it is defended. It is at the point of defense that disciplined capital begins to leave, not because the theme is dead, but because the advantage has moved. Rick Rule's silver reduction did not announce the end of silver's importance. It marked the end of silver's mispricing. And when mispricing ends, speculation must evolve. That evolution did not take him away from silver. It took him deeper into it, into the layer of the system that had not yet adjusted, the businesses beneath the metal, the structures that would benefit, even if price merely stayed where it was. That is where his capital went next. And that shift is where the real story begins. Where the real leverage was hiding. When Rick Rule reduced his exposure to physical silver, he did not move away from the silver trade. He moved beneath it. While much of the market remained focused on the metal itself, on charts, targets, and headlines, he redirected capital toward the layer of the system that determines whether a commodity boom creates wealth or merely excitement. The companies that produce it. This shift was not cosmetic. It was structural. Physical silver reflects price. Silver mining businesses convert price into margins, cash flow, and enterprise value. That difference defines where true leverage resides. By early 2026, most market participants were still thinking in metal terms. They spoke of ounces, shortages, and monetary disorder. Few were examining what sustained higher prices would do inside the financial statements of producers. Fewer still were recalculating the net present value of silver deposits that had been modeled for a much lower price world. This is where Rick Rule's attention turned. Mining businesses are not static. Their cost structures are relatively fixed. Their revenues are not. When a commodity price moves beyond what analysts have assumed, the internal economics of these businesses do not change gradually. They change abruptly. A silver producer operating in a $40 modeling environment does not double its profitability when silver reaches 80. Its margins often triple or quadruple. What had once been a thin spread between cost and sale price becomes an expanding field of free cash flow. Debt ratios improve. Capital projects become viable. Reserves that once looked marginal acquire commercial significance. Entire assets move from being ignored to being strategic. And markets rarely price this transition in advance. They respond to it after earnings force recognition. Rick Rule understood that by the time silver was widely celebrated, silver mining equities were still being valued as though the celebration had not happened. Many producers were trading on assumptions that belonged to a very different price regime. Their share prices reflected caution. Their models reflected conservatism. Their valuations reflected a world that no longer existed. That disconnect created the next asymmetry. In physical silver, further gains required price continuation. In silver mining businesses, revaluation could occur even if prices merely held. This distinction is fundamental. An asset that requires ongoing appreciation to perform is vulnerable to stagnation. A business whose internal economics are already misaligned with reality can generate expansion without any external movement at all. Rick Rule did not need silver to double again. He needed it to remain. That stability alone was enough to pressure valuations, earnings expectations, and capital allocation policies across the mining sector. The shift from metal to miner is often misunderstood as a higher risk bet. In practice, under certain conditions, it is a lower risk one. Mining businesses possess internal shock absorbers that physical metals do not. When prices rise, they can respond, they can expand output, they can reduce leverage, they can acquire distressed assets, they can pay dividends, they can retire shares, they can convert commodity cycles into corporate cycles. Physical metals cannot. They remain inert. Rick Rule's approach recognized that by 2026, silver had likely completed the most violent part of its repricing. What lay ahead was not necessarily explosive continuation, but structural digestion, a period where the system absorbed higher prices, recalibrated costs, rewrote balance sheets, and rebuilt project pipelines. That process favors businesses, not bars. Within the mining sector, he did not approach this shift indiscriminately. He focused on producers with established operations, credible management, and cost profiles capable of surviving volatility. He also focused on companies holding assets that were not yet contributing to valuation, projects sidelined by politics, regulation, or earlier economics. These assets represented another form of leverage, optionality. In mining, optionality refers to resources that are real, defined, and undeveloped. They carry little present value, but enormous future impact. They do not affect today's earnings. They do not appear in today's guidance. But when conditions change, they can rapidly alter a company's trajectory. Higher prices are one such condition. Political shifts are another. Many silver mining companies control deposits that were uneconomic or undeployable in a low-price environment. As prices rise, these deposits move closer to development. As host governments confront fiscal realities, previously frozen projects acquire new relevance. The market often ignores these layers because they do not affect quarterly results. Professional capital studies them precisely because they do not. Rick Rule AS Capital Rotation acknowledged that the greatest gains in a maturing commodity cycle often come not from the asset that led the move, but from the assets that were left behind by it. Silver had moved, the miners had not. That lag created the opportunity. While public attention remained fixed on price charts, the internal machinery of the silver business was preparing to shift. Operating margins were expanding. Exploration budgets were being reconsidered. Development timelines were being revised. Acquisition logic was changing. The industry was entering a phase where companies could not help but generate results that conflicted with the assumptions embedded in their valuations. That conflict is where repricing originates. Repricing does not begin with excitement. It begins with surprise. Earnings that outperform models, free cash flow that exceeds guidance, assets that were dismissed becoming relevant. Those are the forces that restructure sectors. Rick Rule's redeployment anticipated that moment. He positioned capital not for a continuation of enthusiasm, but for the correction of underestimation. He sought exposure not to what people were already discussing, but to what financial statements would soon make unavoidable. For entrepreneurs and investors, the parallel is direct. The most durable opportunities rarely exist at the surface of a trend. They exist in the infrastructure beneath it, in the service providers, in the margin-sensitive operators, in the businesses that translate macro conditions into enterprise outcomes. Rick Rule's move from metal to miners reflected that logic. He did not abandon the silver story. He upgraded his position within it, from observer to owner, from price to process, from narrative to cash generation. And in doing so, he revealed where he believed the next phase of the silver cycle would truly express itself, not in the quote, but in the companies that control the future flow of the metal itself. That realization reframes the entire decision. And it sets the stage for the broader message his action communicates about capital cycles, sector evolution, and the kind of thinking required to navigate the decade ahead. The capital cycle. Most investors never learn to see. Rick Rule. H's decision to sell most of his physical silver and rotate into silver mining businesses was never meant to be read as a trade. It was meant to be read as a study in capital behavior. For more than half a century, his career had not been built on predicting prices. It had been built on observing cycles, how money enters systems, how it concentrates, how it becomes emotional, and how it quietly relocates long before headlines announce a change. What his silver decision revealed was not simply a view on metals. It revealed how professional capital navigates maturing opportunity. Every major capital cycle follows a pattern. It begins with neglect, then discovery, then expansion, then crowding, then restructuring. Most participants only recognize the first three. They enter when discovery becomes visible. They add when expansion is confirmed. They defend when crowding arrives. They rarely prepare for what comes next. Restructuring is not collapse. It is digestion. It is the phase where systems adapt to new realities, where margins replace momentum, where balance sheets matter more than stories, where businesses consolidate, weak participants exit, and capital reorders itself around productivity rather than promise. This is the phase Rick Rule was positioning for. He did not believe silver's relevance was ending. He believed silver's easy phase was. The transition from disbelief to belief had occurred. What followed would not be absence. It would be refinement. Refinement rewards different skills. It rewards operators over holders, allocators over commentators, structures over symbols. Rick Rule's shift from metal to miners expressed that refinement. By rotating capital into silver businesses, he aligned his exposure not only with price, but with operational response. He positioned into entities that could increase output, control costs, acquire distressed competitors, and expand enterprise value even if the metal itself moved sideways. This is what capital does when a theme matures. It leaves the surface. It moves into the machinery. For serious decision makers, this behavior offers a transferable framework. Industries do not generate wealth evenly across their lifespans. Early phases reward those who identify what others dismiss. Middle phases reward those who scale participation. Late phases reward those who understand structure. Rick Rule's action placed silver firmly in that third category. He was no longer concerned primarily with whether silver would be higher in 5 years. He was concerned with how the silver system would reorganize around higher prices, which companies would emerge with strengthened balance sheets, which assets would be unlocked, which operators would absorb competitors, which projects would become strategic. Those outcomes define where durable wealth is built. They also define where mistakes concentrate. As cycles mature, capital becomes more emotional. Investors confuse long-term theses with short-term positioning. They internalize narratives. They defend assets as identities. They interpret volatility as betrayal rather than mechanism. This is when capital is most vulnerable. Rick Rule's career has demonstrated that professional capital does not fight these phases. It exits their psychological dimension and enters their structural one. The same perspective applied beyond silver. His continued commitment to gold reflected not optimism, but arithmetic. The arithmetic of currency dilution, negative real yields, and sovereign balance sheets. Gold, in that framework, was not a speculation. It was a reserve. His interest in uranium was not driven by sentiment. It was driven by contract structures, supply discipline, and the transformation of spot markets into long-term procurement systems. His view on oil was not ideological. It was rooted in underinvestment, decline curves, and the physical realities of energy demand. The capital cycle. Most investors never learn to see. Approx 800 words, documentary-style analytical briefing, third person only. Rick Rule. H's decision to sell most of his physical silver and rotate into silver mining businesses was never meant to be read as a trade. It was meant to be read as a study in capital behavior. For more than half a century, his career had not been built on predicting prices. It had been built on observing cycles, how money enters systems, how it concentrates, how it becomes emotional, and how it quietly relocates long before headlines announce a change. What his silver decision revealed was not simply a view on metals. It revealed how professional capital navigates maturing opportunity. Every major capital cycle follows a pattern. It begins with neglect, then discovery, then expansion, then crowding, then restructuring. Most participants only recognize the first three. They enter when discovery becomes visible. They add when expansion is confirmed. They defend when crowding arrives. They rarely prepare for what comes next. Restructuring is not collapse. It is digestion. It is the phase where systems adapt to new realities, where margins replace momentum, where balance sheets matter more than stories, where businesses consolidate, weak participants exit, and capital reorders itself around productivity rather than promise. This is the phase Rick Rule was positioning for. He did not believe silver's relevance was ending. He believed silver's easy phase was. The transition from disbelief to belief had occurred. What followed would not be absence. It would be refinement. Refinement rewards different skills. It rewards operators over holders, allocators over commentators, structures over symbols. Rick Rule's shift from metal to miners expressed that refinement. By rotating capital into silver businesses, he aligned his exposure not only with price, but with operational response. He positioned into entities that could increase output, control costs, acquire distressed competitors, and expand enterprise value even if the metal itself moved sideways. This is what capital does when a theme matures. It leaves the surface, it moves into the machinery. For serious decision makers, this behavior offers a transferable framework. Industries do not generate wealth evenly across their lifespans. Early phases reward those who identify what others dismiss. Middle phases reward those who scale participation. Late phases reward those who understand structure. Rick Rule's action placed silver firmly in that third category. He was no longer concerned primarily with whether silver would be higher in 5 years. He was concerned with how the silver system would reorganize around higher prices, which companies would emerge with strengthened balance sheets, which assets would be unlocked, which operators would absorb competitors, which projects would become strategic. Those outcomes define where durable wealth is built. They also define where mistakes concentrate. As cycles mature, capital becomes more emotional. Investors confuse long-term theses with short-term positioning. They internalize narratives. They defend assets as identities. They interpret volatility as betrayal rather than mechanism. This is when capital is most vulnerable. Rick Rule's career has demonstrated that professional capital does not fight these phases. It exits their psychological dimension and enters their structural one. The same perspective applied beyond silver. His continued commitment to gold reflected not optimism, but arithmetic. The arithmetic of currency dilution, negative real yields, and sovereign balance sheets. Gold, in that framework, was not a speculation. It was a reserve. His interest in uranium was not driven by sentiment. It was driven by contract structures, supply discipline, and the transformation of spot markets into long-term procurement systems. His view on oil was not ideological. It was rooted in underinvestment, decline curves, and the physical realities of energy demand. Across all of these sectors, a consistent pattern appeared. Capital was not flowing toward what people believed. It was flowing toward what systems required. That is the deeper warning embedded in Rick Rule's silver decision. Modern markets train participants to follow narratives. They provide endless commentary on what assets represent. They rarely train participants to analyze what industries must do to function. But industries operate on constraints, not conviction. They respond to capital scarcity. They respond to margin pressure. They respond to replacement cost. They respond to political necessity. When prices rise and remain elevated, industries do not celebrate. They restructure. Costs adjust. Assets migrate. Technologies change. Governments intervene. Mergers accelerate. Contracts harden. These processes determine where wealth compounds, not the headlines. Rick Rule's redeployment into silver miners acknowledged that these processes were now beginning to dominate the silver sector. The excitement phase was giving way to the operational phase. The metal had done its work. Now the businesses would begin to do theirs. For entrepreneurs and aspiring capital allocators, this moment is instructive. Every field, technology, energy, commodities, finance, produces its own versions of silver, assets that rise because the world finally notices. They also produce their own miners, businesses that rise because systems must reorganize. Most fortunes are not made by owning the symbol of a change. They are made by owning the infrastructure of it. Rick Rule's action highlights that distinction. He did not abandon a thesis. He advanced within it. He did not retreat from risk. He refined it. He did not follow enthusiasm. He followed capital structure. The suspense surrounding his decision was never about what he sold. It was about what his behavior implied. It implied that the silver market had crossed a threshold, that it had moved from being a story about recognition into becoming a story about control. And in markets, control is where the most durable forms of wealth are built. As the decade unfolds, many participants will continue to debate where silver can go. Fewer will examine how the silver industry will change. Rick Rule's S decision suggests that the latter question will determine who benefits most from whatever answer the former produces. Because when an asset becomes believed in, the opportunity rarely disappears. It relocates.